Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action with just an hour left to go in the trading day. A bit more of a muted session that we're seeing today after the big sell-off on Wednesday. We've got the Dow trading flat as well as the S&P 500. The Nasdaq up about 22 points here. The big focus on those after hours earnings coming up in the tech space with Apple and Amazon reporting. Taking a look at sectors today, energy, the big driver so far on the day, up in a big way, and we are seeing all the yields here up as well. We've been watching some of those big moves in the bond yields, or at least the Treasury space, after the downgrade from Fitch yesterday. Well, investors waiting for Apple and Amazon to report their quarterly results after the bell, but with the market's tech-fueled rally this year, the pressure is on for these tech giants. Yahoo Finance's Jared Blickery is here at the Wi-Fi Interactive with the breakdown. Jared, the very last of those big tech results, are they going to deliver?
Oh, that's a big question. I recommend everybody tune in after the bell for those, but I can tell you what might happen. And first of all, Apple has been, well, it is one of the most important stocks besides Tesla. It's a huge bellwether. And let me just show you this chart of Apple, which is from the lower left to the upper right on a year-to-date basis. This is a great, nearly perfect trend here. Amazon, almost as perfect as well. You can see it's up 54% for the year. And when we're talking about the importance, yes, for the first 5-6 months of this year, Apple and the other Magnificent Seven, those were huge contributors. In fact, they made up almost all of the gains. Here we have the Magnificent Seven, and they are still dominating. I just did the calculations. Apple, with its 47% year-to-date return, is making up 19% of the returns of the growth in the S&P 500. Take a look at Amazon, about half of that, but that's because Amazon is about half the size. Amazon up about 54%. So back to the main point here, Amazon is in the consumer discretionary sector and Apple is in the tech sector. And when we take a look at the best sectors of the year, guess what? Tech is number 2 and consumer discretionary with Amazon is number 3 there. And if there's anything that's going to potentially upset the glide path higher for Apple and Amazon, it might just be the 10-year T-note yield. And this has to do with that Fitch ratings downgrade at least a little bit, but 10-year yield rates have been screaming higher. This is bad for growth stocks. And when we have a lot of bond market volatility, that's bad for stocks in general. So I do want to pivot a little bit. I found this interesting analysis from Morgan Stanley. This comes from the market ear. And basically they're saying that for the last 5 consecutive quarters, Apple has been disappointing on guidance. So they're going to report in the June quarter. They're going to be reporting what they expect for the September quarter. But if it beats, in other words, if it bucks the trend of the last 5 quarters, they're saying there's a really good chance that we're going to see some upside in Apple stock. So they're saying predicting Apple's June quarter meets expectations. Okay, that's fine. But they foresee September quarter's revenue and gross margin significantly surpassing consensus. And this is due to stable iPhone builds, seasonal Mac strength, low teens services growth. Bottom line is we could see some tremendous upside for Apple if they do finally beat on guidance. So that's going to be something I'm looking for here. When it comes to the options market, we can see what they're pricing in terms of volatility. And in Apple, they're pricing in about a 3.5% move. That's actually a little bit less than normal. And in Amazon, they are pricing in an 8% move. That's also a little bit less than what you would see on these earnings days. So we should see a little bit of volatility. The options market, not expecting anything skyrocketing, but always going to be interesting to see what actually comes of this. And of course, we got to monitor the price reactions into tomorrow.
Yeah, Jared, you talk about the guidance on Apple. A lot riding on that release of the iPhone 15 in the fall. We'll be watching. Jared Blickery, thanks so much for that.
All right, we are in the thick of earnings season. 170 S&P 500 companies reporting results this week. According to FactSet and the headliners after the close, Amazon and Apple, we're watching those closely. Joining us now is Laffer Tangler, Investment CEO and CIO, Nancy Tangler. Nancy, thanks so much for joining us. So let's kind of dive right into the key focus for today amid this earnings season. I mean, you've had about 80% of companies beating expectations. You have these two kind of bellwether companies, if you will, especially Apple. I mean, they've made up, as Jared Blickery just pointed out, a significant portion of the rally that we've seen. What does Apple or Amazon need to deliver, and pardon the pun, to not upset the apple cart, if you will?
Oh boy, thanks, Diane. That was an excellent pun. So I think that a couple of things. I think they have to provide strong guidance as we move forward, and there has to be at least a maintenance of or expansion of margins. What we've seen this last quarter is, I find it just amazing that almost every quarter, 80% of the companies surprised to the upside. But this quarter is particularly important because expectations were so low. So what we've seen, and I think this comes from the fact that managements have been waiting for the Godot recession now for almost a year, and they've had time to prepare. So they've laid off staff, they've cut costs, they've improved supply chains. We saw that with Starbucks in the most recent report. And so what we really want to hear from these companies is that they are going to continue to deliver on margin, and they are providing positive guidance as we look forward.
Yeah, and Nancy, on that front, we've been following a lot of these consumer-facing companies. Apple's certainly one of those, Amazon another one. And the commentary seems to be that, yes, the consumer is still very resilient, but they are starting to get a little more cautious. And I imagine we're likely to see that reflected in Apple numbers as well. But what's your read on what we've heard from the companies as well, and to what extent that is indicative of what we're seeing in the broader macro environment?
So, Kiko, we were advocating and we were following our own advice by adding to technology and consumer discretionary last fall. It seemed to us that we were closer to the end than to the beginning of the rate hiking cycle. No big surprise there. And that inflation had peaked in June and was coming down. And so we added risk back into our portfolio. Those are also the names we've been trimming in recent months because they've run so far, so fast. But if you step away and just look at Starbucks as a bellwether for the consumer, what you'll see is that they saw increased engagement on the digital side of their business. So 75 million users, 4 million new from a digital 90-day kind of average user. Saw 20 million peak. It's a peak number in China. And they raised guidance on revenues and earnings, revenues from 10 to 12%, earnings from 15 to 20. So I think what we're seeing is that the consumer is still spending in areas where they find value or they find satisfaction. You saw today in the ISM services numbers that prices paid came in at 56, which is well above expansionary levels. So I think you have to go company by company. You have to own the high quality companies with the proven management teams that can continue to deliver earnings growth in a slowing economic environment. And that's what we've been focused on in our portfolios.
Nancy, let's talk about those margins that you mentioned. What do you see enough improvement in terms of inflation at the wholesale level for companies to improve their margins?
Yeah, exactly, Diane. I mean, what you saw in this inflation cycle was that PPI peaked in March, CPI peaked last June, and now we're in an environment where PPI is down to like 0.1%. It has been leading inflation down, and companies have been taking advantage of that by maintaining margins. So they've been able to pull back a little bit on pricing, though some companies were still seeing pretty aggressive price increases. But in general, what you're seeing is that managements have been able to manage that. And I also thought today's productivity numbers were pretty encouraging. They're notoriously volatile, so I don't want to read too much into this, but productivity came in much stronger than expected. Unit labor costs at about a positive 1.6% for the last quarter. We can live with that. I think the Fed can live with that. So we'll be continuing to watch throughout the season, but we're seeing a common theme among the higher quality names that we own.
Nancy, let's talk about the broader market action. We've seen the S&P 500 edging lower for a second day. This coming after the big sell-off we saw yesterday on the back of the U.S. credit being downgraded by Fitch. You say we're still in a bull market, but where do you see the opportunity to invest right now?
Well, I think, Akiko, that you want to own companies that can deliver earnings growth when you're in a slowing economic environment. And I don't know if we're going to get a hard, soft, no landing, but I do know the trend, and that is that growth is slowing. The government, and this is, I think, Fitch's downgrade matters only because it drew attention to the fact that the government is sucking capital out of the private sector in a, I don't know, an unprecedented manner that in my career of 40 years. So we will see slowing growth despite the spending that has been coming out of Washington. And that's when you want to own the companies that can deliver growth. So think the technology companies, that the large cap names, the established names, the ones that are going to benefit from the AI tailwind, the cloud tailwind, the digital tailwind. And then our other theme is old economy companies that are embracing the digital revolution. So this would be a name like Starbucks, but there are plenty others in our portfolios, a number of industrials that are really turning into technology companies, if you will, or even a Pepsi who says we are a technology company that happens to sell snacks and beverages. And so those are the names that we want to own with strong management teams that will deliver through this period. If you get a dividend and a rising dividend, that's even better. But this is not the time where you want to go uber defensive and own the highest yielding names in the S&P. You want to own dividend growers that are able to also support their earnings growth.
So, Nancy, I want to put a pin in that because I definitely want to come back to that conversation about particular stocks that you like. But I just want to get your perspective, especially while we have you now. We talked to a lot of economists fresh off the heels of that downgrade. A lot of people were surprised by it, not so much by, I guess, it happening, but the why now? What was your take, or what is your take on that downgrade?
I mean, I think it's late. To be honest, I think they're trying to get in front of the presidential election, so they're not implementing a downgrade during a presidential election year. But I think what we all know is that about half of the U.S. Treasury, the debt, is going to come due in the next 1 to 3 years. That half is at an average coupon of about 1.6%. So you didn't really have to be super good at math to understand that debt servicing is going to go up dramatically. We think it's somewhere between $250 and $400 billion this year. And that is just simply not sustainable. And so I think that's Fitch's message, which is the spending needs to come in. I don't know that it will, but it's drawing attention to it. I think that's good. But other than that, I don't think it's very meaningful.
Mm-hmm. All right. Go ahead, Akiko.
Yeah, Nancy, we've been talking about where the economy is headed. It feels like we've been having this potential recession conversation for more than a year. Expectations for that have started to recede, while inflation easing has given some sign of optimism for investors. But there is a question of a soft landing. Where do you see that going right now?
So I just wrote a piece called The Perfect But Not Necessarily Soft Landing, because I'm up in Tahoe and I landed a perfect face plant on a granite slab recently. And so it just was mindful of the economy. If you land it just right, I was able to protect the rest of my face by using my nose as an airbag, according to the doctor. But I think that you have to, as an investor, understand the trend line. And what the market's not anticipating. I do think that we might have an uptick in inflation between now and the end of the year, and the market's definitely not pricing that in. I would use that as an opportunity to step in and buy the higher quality names that will go on sale with everything else during that correction period. But that's just a speculation. I don't know that that's going to happen. I think, however, that what we're seeing is companies are raising earnings estimates. So the hard landing scenario, in my view, is out. The soft landing or no landing are more likely. And again, all I need to know as an investor is that growth is slowing, and that allows me to allocate my portfolio accordingly.
And Nancy, speaking of that soft landing scenario, let me just give some context to where I want to go with this. So Bank of America dropped their call for a recession this year. Do you agree with that assessment? And is a soft landing, in your eyes, no recession?
Pretty much, Diane. I mean, answering the latter part of your question, I think a soft landing is kind of no recession, at least one that won't be widely felt. I think that, I don't want to sound cynical, but I think following the strategists is never a winning strategy for investors who are trying to buy low and sell high. So many of these same strategists were extremely negative last year when you actually should have been holding on to and adding to your equity holdings. And so I think now it's just a little bit too late, too little, too late. They may be right, but the market's already reflecting that. The market already discounted at least an extension to the recession last fall and into the first half of this year. So now we're looking forward and saying earnings estimates are on the rise in the first half of this year. They're going to be much stronger next year. And that's really what the market's focused on, rather than do we or don't we actually have a soft landing or no recession at all.
And I want to talk more about those equity holdings. Nancy Tangler, don't go anywhere. We will be digging into your stock picks in just a few. We are just getting started here on Yahoo Finance Live. Coming up, tech giants Apple and Amazon are set to report after the bell today. We'll bring you the numbers and expert analysis when the results hit the tape. Plus, shares of Warner Brothers Discovery in the red following, and they actually popped higher. It did have an earnings miss for the quarter, but could things get worse as the Hollywood strike persists? And former President Donald Trump will be stepping into a courtroom in D.C. this afternoon to be arraigned on 4 criminal charges. We've got the details on that and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's do a check of the market sponsored by Tasty Trade. All three majors in the red right now, struggling to come out of that sell-off that we saw yesterday, with the Dow now down 45 points, the S&P 500 down 10 points, and the Nasdaq down 17. Also taking a look at the VIX right now, the fear gauge after the risk-off sell-off or yesterday that we saw yesterday, it is down about 0.2% at 1606. Well, stocks off their lows today, but being in the thick of earnings season, investors are constantly looking for investing opportunities, but also warnings on stocks to avoid. Laffer Tengler Investment CEO and CIO Nancy Tengler back with her picks. And Nancy, let's begin with those stocks that you like. Kind of something you mentioned earlier, Starbucks. You kind of described this as more of a legacy company that really is getting consumers to sort of stick with the brand, particularly through their digital strategy and loyalty. What do you like about that?
Well, I think most importantly, Akiko, is I really like the new CEO, and that matters. You know, investors should be investing like private equity investors do. They should be buying the management team. And he has demonstrated pretty clearly that he understands the global market in a way that I don't think previous CEOs necessarily have. And he has hired a new supply chain head of supply chain, who is really going in and looking at every aspect of the business, which allowed them to improve margins during the quarter. I just finished the second edition of my book, The Women's Guide to Successful Investing, and I wrote about Starbucks in that book. I bought it in April of 2007 at 30. It promptly went to 5, and just left to its own devices since then, it's up tens of thousands of percent in total return, simply because this is a great company with a great brand that figures it out over time. They stumble, and that's an opportunity to add to holdings. And so we did that last year, and we will continue to add to holdings because I think they're going to be able to deliver on their pretty aggressive earnings and revenue growth numbers.
Oh, Nancy, I will be reading your book, especially when you give that context for that call. I mean, it's a big move since then. To your point, left to its own devices, even including the pandemic when so many stocks sold off and then popped back, and Starbucks has held up. I did listen to their earnings call this week, and there was, you've made this point about some skepticism. There was, particularly when you think of U.S. sales. They talked a lot about China, but the penetration isn't there yet in China, especially to offset any kind of softening in terms of sales growth here in the U.S. You still like it in the face of skepticism?
I do, Diane, because I think, first, Wall Street analysts are not very good at turning points. Most people aren't. That's why we use a discipline that forces us to pay attention at turning points. But I think also this is a management team that will figure it out. And the digital engagement, I mean, what Laxman said on the call was not just that he wanted to embrace the digital portion, but he wants to scale it. And that is how you get productivity and improvements in a name like this. And they have a lot of room for improvement. McDonald's noted, I think it was 4 to 5 times the downloads of their digital app last quarter than Starbucks did. So even with the improvements in Starbucks digital app, there is plenty of room for growth. And we think he's the one that is going to get that accomplished. And so we're getting paid a 2% dividend, 12% growth in that dividend. So we can kind of afford to just hang out and wait for the management team to get it right. They will. They have in the past, and they will do it again.
Another pick you like, Nancy, is Broadcom. You've mentioned this before, and this is one where you're standing by your man. Now, to be fair, it has performed well since you last called for this as a pick. Does it still have more room, especially when you see some struggles that its competitors have?
Yeah. Oh, the chip names have been really sort of confounding this quarter. Some really good reports and some not so good reports, like we saw from Qualcomm today. But yes, and here's why. I think a couple of things. One is this is a name that well, first of all, they've beaten 12 out of the last 12 quarters. And they've not just beat on revenues and earnings, but they've raised guidance every single quarter for the last quarter. It's a management team that understands their business infinitely. We weren't counting on the AI tailwind, but we got it, and we think it will continue to contribute materially to earnings growth in the future. You have the VMware transaction will close. That's good news for the stock, which is really actually about 50% software after that transaction and 50% chips. And then in addition, you are getting paid 2.1% dividend yield with 23.5%, I think, 5-year annualized growth in the dividend over the last 5 years. I'll take that all day long. The stock is trading close to $1,000 a share. I think you're probably going to get a split, which doesn't add any economic value, but adds to sentiment. And so I think when technology sells off, and I expect that will happen between now and the end of the year, this is a name you want to go in and scoop up.
And Nancy, let's talk about some of the names that you say investors should steer clear from. UPS, one of those. How much of this has to do with rising costs? You know, on the one hand, UPS averted the worst case scenario with a strike, but when you look at the tentative agreement, that only points to higher costs ahead.
And that's the reason, Akiko. I mean, I think there's just better places to be. You want to own industrials when the manufacturing PMIs are bottoming. They are, but you want to own the short cycle names. So even though I think Carol Tomé is an excellent CEO, I think, you know, you are getting paid to wait. So if you own the stock, you're collecting a pretty nice dividend. I think the stock will outperform in the future. But in the near term, I just think there are better places to be. So if you don't own it, don't buy it here. I think it's tempting, but I wouldn't. We're exiting the name and we're putting the proceeds into short cycle industrial names. And that's where I think you want to be focused in the next 9 months to a year.
And Nancy, another one that you don't like, and you've mentioned this before, actually, CVS. And once again, you've nailed this one. I mean, year to date, the stock is down 20%. It did beat on its latest earnings. However, there's some caution there. Take us through the case for steering clear of this one.
Well, Diane, thank you. I think it's again, there are better places to be in healthcare and certainly in consumer staples / discretionary or retail, however you want to characterize the name. I would use this bounce to exit. And the reason for that is the balance sheet is burdened with debt. You know, they were just paying it down, starting to grow the dividend, and then they made a number of acquisitions. I don't really get the model. I mean, I understand it, but I'm not convinced that it's going to be a high growth name in the future. So it's one of those names that could, you know, sit in a portfolio and contribute from a dividend growth perspective. But again, we're finding much more attractive places to be in the market. And I just don't think, I think this is dead money. You are collecting dividend. I don't think it's going to grow very much because the company has a lot of debt to pay back. And there was a lot of concession around the fact that their earnings growth is going to be slow. So I just wouldn't invest the capital here. I'd look for better opportunities in healthcare, consumer staples, and consumer discretionary.
Nancy Tengler with Laffer Tengler Investments. Some good takeaways there. Really appreciate the time today.
Thanks so much.
Meantime, Tesla facing a class action lawsuit over its EV driving ranges. Pras Subramanian is here with the details. So, Pras, we've got another thorn in the side when it comes to Tesla, right?
Yeah, you know, the next shoe dropping here after that big Reuters report talking about how Tesla may have used an algorithm to improve or show rosier range kind of display in the car when actually you're getting a much less range. So now comes a proposed class action lawsuit where the plaintiffs are alleging that Tesla breached vehicle warranties and engaged in fraud and unfair competition. The 3 plaintiffs allege that they got less range than advertised. In fact, one said he lost 182 miles of range and only got 92 miles that day. Now, I got to say though, EVs sort of have a lot of a broad variance in range when it comes to warm weather versus cold weather versus other conditions. But for some reason, Tesla, according to Consumer Reports, has the widest disparity in range across different conditions, basically getting much less than what the EPA actually certified them to get. So I think this is sort of an ongoing issue, and like you said, another thorn in the side for Tesla. We'll see if they maybe try to dispose of this lawsuit by settling, or who knows, because I don't think they're going to want to get into discovery and emails. And they also had this diversion team, right, where they actually had a team in Las Vegas where people complained about range. They got sent to this team. They got the complaint rid of, and they would bang a xylophone to, kind of like a boiler room type of fun activity there. So a lot going on in that report from Reuters. Right. So we'll see where this actually goes from a legal point of view.
Yeah, but I could see that even just anecdotally. I had my first experience. I rented a Tesla while on vacation last week, and I could see the difference in just the battery life, and one day to the next day after charging it, and just literally it was like temperature, it seemed like affected that. So I can see the issue. Again, to your point, we'll see if this has legs, right?
Yeah, a lot of people so used to gas-powered cars, and your range just sort of sticks with how much gas you have. Actually, that does vary based on temperature, but EVs in particular a lot more because the battery has to be cooled or warmed before you use it, and that takes a lot of energy.
All right, thank you, Pras. Supermanian.
Thank you.
All right. Mortgage rates rising in the latest week. We're tackling the latest real estate realities. That's on the other side. Stay with us. It is getting more expensive to buy a home. Mortgage rates rising towards 7%. This not good news for home buyers who are already navigating higher home prices and fewer options on the market. Our Danny Romero has been following this. Danny, this is, when I saw this number, I'm like, how much higher can we get? 6.9%. This is crazy.
Yeah, sorry, home buyers. It's getting expensive out there. The average 30-year fixed mortgage rate hit 6.9% this week. That is the second highest level. Now, why are rates increasing? There are several factors weighing into this. For one, the unexpected debt downgrade from Fitch ratings that pushed Treasury yields up. Remember, fixed mortgage rates tend to go hand in hand with the 10-year Treasury yield. Second, the U.S. Treasury Department said that it plans to sell $100 billion in long-term securities. So investors have been weighing the effects on higher borrowing costs on riskier assets. What does this mean for mortgage rates? Experts say that mortgage rates are likely going to go up, and especially we've heard from the Fed that they haven't reached their 2% inflation goal, so rates are likely going to increase, Diane.
Danny, when you think about the impact of higher rates, it's not just about the buyers, it's the sellers who've remained on the sidelines because it's not worth it for them to sell right now. I mean, what is the tipping point to unlock supply? Is it still 5%?
Homeowners, like you said, higher rates has made homeowners reluctant to sell and move, but a new survey from Zillow says that homeowners are twice as likely to sell if they have a mortgage rate 5% or higher. But most homeowners actually have a rate that's lower than that, about 80% of people do. But again, what does this mean? Over time, homeowners are likely going to accept a higher rate that could become the new normal, but the market will still be challenging for home buyers, especially that home prices are still high and the fact that rates are also high. This could just definitely, and fewer options. We have to put that into this equation.
Not a lot of hope on the horizon, at least when it comes to the home front.
Yes.
All right, thank you, Danny Romero.
Well, the inventory crunch on the housing market getting worse last month. New data from Realtor.com shows there are 20% fewer homes newly listed up for sale in July compared to last year. Danielle Hale is the chief economist at Realtor.com joining us now. Danielle, Danny just talking about that 5% rate, which is kind of the tipping point that gets sellers or potential sellers off the sideline. I mean, what are other factors that you're finding that's really adding to that supply crunch?
I think the mortgage rate lock-in effect is a big one, but it plays into this overall affordability picture. So we look at the number of homes that are on the market right now, it's down. But then if we look at the number of homes that we've built over the last decade, it's really trailed the number of households that have created. The most recent data from the census, the housing vacancy survey, showed that homeowner vacancy is at a record low of 0.7%. There just aren't a lot of homes that are out there sitting empty, unused. And when you don't have slack in a market, which is very much the case in the housing market right now, you tend to see a lot of upward price pressure. And that's a challenge when mortgage rates are back getting close to long-term highs, close to 7% again, because already prices are high, borrowing costs are high, there's not a lot of affordability for buyers, and a lot of potential sellers are going to turn around and buy. So what's a problem for those buyers is also something that factors into a lot of seller decisions as well.
So Danielle, Diane here. So you're not winning if you're a seller, you're not winning if you're a buyer. Who's the winner in all this?
Yeah, I mean, I think people who can manage to find a new home that fits their needs, it's in their budget. It's not easy, but it can be done. And those are people who can win. There are some advantages for buyers right now. The fact that there aren't a lot of homes for sale is not one of them, but there's less competition in the market right now because not everyone can navigate these higher home prices and higher mortgage rates. Another opportunity is for very equity or cash rich buyers. They tend to be older buyers, maybe baby boomers who are looking to downsize, especially if they're considering downsizing from an expensive market to a lower cost market. They have some flexibility right now in a market that's less competitive than it has been over the past couple of years. So even though it's a challenging market, home shoppers do have some means of navigating it. And we're seeing this in our data. Our cross-market demand data shows that a record high number of people are looking for a home in a market other than where they live. So we think affordability is driving a lot of that trend, especially when you consider that the biggest areas where people are looking for homes elsewhere are in the West. And then the fastest growing region for people who are shopping elsewhere is the Northeast. Those are also very high cost markets. So people who are in high cost markets are looking for homes elsewhere, really trying to capitalize on affordability.
I mean, does that suggest further migration then as a result of affordability if you're looking at a market outside of where you are right now because you can't buy a house there?
Potentially. What I think is interesting, so we're measuring this as a share of the market. And so while the absolute numbers of people moving far away may actually be lower because we have seen fewer home sales this year, and we expect to see a 10-year low in home sales in 2023 as a whole, they are an increasing share of the market. So the people who are moving right now are the people who have that flexibility to maybe relocate, or maybe they're at that retirement stage in their life where they don't need to stay tied to their current location and their current job. And so, they're willing to relocate. I think it's very surprising in light of the fact that we're seeing a lot of return to office behavior increase. And so, greater demands on workers to be in the office. In spite of that, we're still seeing a lot of cross-market shopping. We think affordability is driving that. In fact, in research with the Wall Street Journal, we found that markets in the Midwest are topping those areas where housing markets are still good. We're still seeing price growth, quality of life indicators are good. People are trying to have their home and be able to afford it, and affordable areas continue to pop to the top of our list.
Danielle, going back to that supply crunch, what we have seen is that's led to a big uptick in construction. We saw that reflected, for example, most recently in those numbers we got out from Caterpillar. At what point does that construction supply coming online catch up to the demand and the supply that's needed?
Yeah, I think just understanding the magnitude of the problem, depending on the assumptions you make about multifamily construction and single family construction, you can get anywhere from an estimate of like 2 to 6 million homes that we're short. And for context, we build about 1.5 million homes a year. So it's a huge hole. Even if all we did was build to fill the gap that exists, we're looking at a 2 to 5 year problem. And that's not considering all those new households that are formed. So there is a lot of opportunity for construction. And I think that's going to continue over the next several years. Fortunately, if you look at multifamily construction in particular, the number of multifamily units under construction right now is at a record high. So there is some relief on the way for renters and apartment dwellers. And single family construction has been relatively high, not at the peak of its range, but it could stand to benefit from some more construction as well.
It is incredible to think that 2 to 6 million lag. That is a long time until we kind of see the catch up there. Danielle Hill, it's good to talk to you today, the chief economist at Realtor.com.
Thanks for having me.
Well, coming up, more headwinds in store for Warner Brothers Discovery after second quarter earnings missed estimates. What's next for the streaming giant? We'll have that discussion on the other side.
first thing that you have to do is figure out what your retirement looks like. And I know that that sounds really obvious, but in particular, we know that there is often a disconnect between couples. When are you retiring? Where are you retiring? What will you do day to day in your retirement? Will you continue to earn some sort of an income, as many people do?
Only 56% of people think they're on track for having the retirement they want to have. And in particular, we saw this enormous drop in Gen Z.
All the young people, I need them to get on budgets and then find the money in their budgets to contribute to their 401ks or IRAs or any type of workplace retirement plans, because if they start now, it is amazing how compounding interest will grow for them over time, and they are going to meet that retirement goal of $1.3 million.
My favorite thing is to tell people, don't think that you're saving for retirement. You're saving for your life.
It's really up to each individual to build out an asset allocation that is perfect or right for them. That's going to include stocks, that's going to include bonds, and within stocks that may include several different types of stocks: large cap, mid cap, small cap. Bonds may include government bonds, international. You also want to look at commodities. That might be a good place for an inflation hedge, right? Or real estate are a good option. So it's not just about focusing on stock, it's building out a diversified portfolio within that retirement plan.
I keep meaning to do it, but I keep forgetting to, actually go through with it.
401k, no. I work for myself right now, and no, I'm not really thinking about retirement at the moment.
I started a little bit late, but I'm definitely making my way on that. I'm saving a little bit, yes. My mom told me just don't look at it, just leave it alone.
I do have a Roth IRA, and I have some money in there.
You can right now take early retirement age 62. If you know you're about to die of cancer, and you've got 3 years in which the doctor tells you you're probably going to die, take your benefit age 62. But for most people, it's wiser to wait until age 70, because over the course of a normal lifespan, you'll receive more money if you wait until age 70.
People have this idea that once they reach Medicare age, that everything's covered. Clearly it's not. And the premiums you pay have to be accounted for too. So you have to have a plan for healthcare costs in retirement. We recommend taking a look at HSAs in your pre-retirement years if you have access to one, because that allows you to have tax-free money to pay for healthcare costs in retirement.
A lot of people are looking at young people and people pretending to be rich and having these amazing lifestyles. And it's all really not real. The TikTok and Instagrams of the world are showing all this, and people are actually believing it. And I always say, there's no get rich quick, only get rich slow. So be careful where you get your advice from.
Our goal is to tell great stories. Stories with the power to entertain, and when we're at our best, inspire. With stories that come to life on screens, big and small. And we cannot do any of that without the entirety of the creative community. We're hopeful that all sides will get back to the negotiating room soon, and that these strikes get resolved in a way that the writers and actors feel they are fairly compensated.
That was Warner Brothers Discovery CEO David Zaslav on the company's earnings call earlier today, discussing the writer and actor strikes. Now, the company reported around $100 million in cash savings in the second quarter as a result of the strikes. The CFO of the company also saying if the strikes run through the rest of the year, they can expect several $100 million of upside to free cash flow guidance. For more on this, we turn to Alex Weprin, the Hollywood Reporter, media and business writer. Alex, good to talk to you today. So free cash flow in the short term, it's good for the company. Investors like that. But what does that pipeline look like for Warner Brothers, and how long can they hold out in the strike?
Yeah, it's a paradox. In the short term, they're going to have all this extra cash that they can use for other purposes, to pay down debt, to acquire other content like sports or more reality shows. But in the long term, they do need new scripted TV shows and movies in order to conduct their daily business. They're in the business of making these shows, and eventually a lot of this cash is going to be needed to fund those productions. So it's a problem. It's a good problem to have because it's good to have extra cash, but at the same time, they need to manage it. They can try to deploy it now, but eventually they're going to have to put it to use creating new content, and they're going to have to think about what it means down the line. In terms of content, I think they're probably okay for a couple months, but the longer the strike goes on, if it goes another month or two, we could begin to see really negative effects, especially in 2024, which is when a lot of these series and movies are set to be released that are currently paused. So really, that's when you'll start to see the impact on their bottom line.
Alex, I want to ask you about AI in the context of content, particularly, that's been one of the sticking points in terms of negotiation and concerns when it comes to SAG-AFTRA. What are you hearing about what Warner Brothers is doing or incorporating when it comes to content and AI?
So Warner Brothers Discovery, like all the major studios, they're beginning to play around with AI technology and see what it's capable of. Now, of course, it's used for things like algorithms, like to recommend new shows or movies. It's used in special effects. If you saw the new Indiana Jones movie, you'll see a de-aged Harrison Ford that was helped in part by AI. But at the same time, the potential to maybe write scripts or to create digital actors, that's something that the writers and actors are really concerned about. And I think the studios are just at the very beginning stages of beginning to see what it's capable of. So they're hiring for a bunch of different positions. Some of them may not really be relevant to the guilds at all, like a customer service AI. But others, like when you think about the possibility to use it to create written content or digital content, that's something they're really worried about. Warner Brothers Discovery, Sony, Disney, they're all testing the technology. They're exploring the boundaries of what it's capable of. And at the same time, the guilds, they want to lock in rules to make sure that it can't be used to take their jobs.
Yeah, Alex, there were several reports this week that pointed to the job postings out there, AI related, some offering as much as $900,000 a year. So the concern among the unions, AI has been one of those that have been top of mind. But is there an irony here that in some ways, as they try to negotiate and sort of protect their jobs from AI, that studios, that could actually accelerate the transition to AI for studios?
Well, that's a problem, right? Because, at the same time, the technology is still very nascent, right? It's not capable of creating an entire film or TV show yet, but that is a concern down the line. At the same time, these studios are all looking desperately to save money. They're looking to cut costs. That's why there are all these layoffs in the entertainment business throughout the year. And so AI is a technology that can really be used for that purpose, to cut costs, to reduce the total number of jobs that a company has. And you're right, if the strike drags on, these companies may get more aggressive in looking to see if there are other ways they could use the technology to reduce the total number of job opportunities or to cut costs in other ways.
Speaking of cutting costs, Alex, one of the things that's been talked about besides layoff is spinning off, selling units. One of the properties that's been talked about is CNN. What did you hear? What are you hearing with regard to that piece of Warner Brothers Discovery?
So in the last year or so, there's been a lot of talk about potentially selling or spinning off CNN. I'm hearing right now that that's not on the table. That being said, as time goes on, anything is possible. And certainly if someone approached Warner Brothers Discovery with a really aggressive deal to buy CNN, I think they'd take a hard look at it. They're in primarily the entertainment business. CNN is a news property. So, it fits into that larger portfolio, in the sense that entertainment and news and sports all tend to live side by side. But, if someone made an aggressive offer, I think they would absolutely take a look at it and sell it. It's been, other private equity firms, other media companies, they've poked around CNN. They've tried to see if it's available and see what, if they can get into the books a little bit. But right now, it doesn't seem like any sort of sale is imminent.
Finally, Alex, we are expecting the WGA to meet with the studios tomorrow. It's the first time they'll actually be at the table, sort of a meeting to discuss a meeting. But what are you hearing about how close the two sides are and where the leverage lies?
So you have to keep in mind that they haven't really spoken in 3 months. So, they're not starting from scratch, but it's going to be baby steps. This is going to be the first meeting. They're going to lay the ground rules. They're going to begin the process of returning to the table. Last I heard, they were still very far apart on a number of key issues, including AI, including compensation for residuals and streaming. So there's a lot of ground they need to cover. At the same time, the fact that they're returning to the table is good news. Before any deal can be struck, this is the first step. Same thing with the actors. At some point, the studios are going to sit down with the actors and they're going to begin talking about a deal. Everyone expects there to be an agreement at some point. Warner Brothers Discovery today said they're kind of planning on a September return. But the first step is to get to the table, and so we'll see what happens from this week's meeting.
Yeah, September return sounds pretty optimistic there. Alex Weprin with The Hollywood Reporter. It's good to talk to you. Appreciate the time.
Thank you.
All right, switching gears, shares of Papa John's have been fluctuating. Now on the plus side, they did miss estimates in the latest quarter. The pizza company citing a, quote, challenging operating environment. Yahoo Finance's Brooke DePalma spoke to CEO Robert Lynch earlier today and joins us now with more insight. What was your takeaways from that conversation?
Yeah, well, there was quite a few. I mean, inflation really took a toll on Papa John's back in April, and now they're looking to work back from that. But really, North America, the big story there, same-store sales down 1% in North America as a result of a 2% actual increase in company-owned stores, offset by a 2% decrease in franchisee restaurants. Rob Lynch telling me that miss was driven by those franchisees who really tried to hold on to margins in this inflationary environment. He did say that they drove some significant price increases that were kind of inconsistent with what the consumer really expects and the value that they're looking for at Papa John's. And now as they look to the rest of the year, they're really trying to close that performance gap between both company-owned and franchise-owned restaurants. He said to Yahoo Finance that they're going to help their franchisees rise up to the level that the company restaurants are performing. And one way that they're going to do that is by doubling down on value. Now, he said that the brand really does well in a tough economic environment, given the value that they offer. And while quick service restaurants, doing a quick comparison there, he said that they're seeing lower transactions, but Papa John's growing transactions. He said that our value relative to traditional quick service restaurants has never been stronger, with offerings like that Doritos Cool Ranch Papadilla for $7.99. And he is bullish on the back half of the year. The company now expects full year same-store sales to be flat to up to 2%. They did note that it's not going to be enough to offset what happened in the front half of this year. But I also had to ask him about his perspective on that recent announcement between Domino's and Uber Eats. And he said, well, Domino's is coming in, but we've been competing. He said that, quote, we're still the leader. We're going to hold that position. We're focused on it. It's a big source of growth for us. So I say, the more, the merrier. Of course, Papa John's went into that space of aggregators about 4 years ago. They're on Uber Eats, DoorDash, and Grubhub. And he said that when they made the decision, it was a strategic decision. And like I mentioned before, he said that they've been competing already in this space. And so bring it on.
All right, pizza for dinner. Brooke DePalma, thank you. All right, coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
Oh, there it is, the closing bell on Wall Street on this Thursday. Let's do a quick check of the market, sponsored by Tasty Trade, and it is red across the board for all three majors. The Dow down 70 points, the S&P 500 ending the day down 11, and the Nasdaq down 13. Shares of Expedia Group closing the day in the red following mixed earnings report for the second quarter. The online travel company saw record revenue of $3.36 billion in Q2, but it still fell well short of Wall Street estimates. And Diane, we've been talking a lot about earnings and the big beats. On the one hand, it is about this quarter coming in with such low expectations.
Right.
You look at a name like Expedia, it is about expectations being so high because of what we heard on the travel demand. In many ways, that's what's happening with the stock in terms of the big declines we've seen there.
That's right. It certainly fell short. Go ahead, Kiko.
Well, I was going to say there is such a thing as maybe expectations being too high going into it. But when you think about some of the other travel names that have been reporting, analysts expecting a little more from Expedia, certainly not beating the bar, at least with shares down more than 16%.
Especially to your point about what the expectations were for travel. And we've seen such strength there with this experiences play that we've seen with a lot of both the airlines, the cruise lines, and just travel stocks in general. Gross bookings for Expedia did increase, but less than expected. I mean, it rose 9% to $27.3 billion. Analysts were looking for $28.3 billion. Lodgings, it did come in at a record, actually, $19.2 billion, but again, short of what expectations were. And just that question of, is there softness coming when it comes to the travel picture and what that looks like, whether we're talking about airlines or hotels? Another stock that we are watching is shares of Wayfair. That stock finishing the day well in the green on the plus side, up by about 16%. So the flip of what we've seen with regard to Expedia, its results soaring past estimates in the second quarter. Despite seeing active customers fall, the online furniture retailer continues climbing after reporting adjusted earnings per share of 21 cents a share against, they were expecting a loss. So it was a surprise gain for Wayfair. I mean, look, you remember this was a pandemic darling, and then it lost its luster and now it's come back. Akiko.
Yeah, this is a company that has really been really moving aggressively to try and slash costs. They've laid off about 10% of their staff, and we're starting to see a bit of a turnaround. Interesting to see how the sentiment has shifted on Wall Street. In recent days, we saw Piper Sandler upgrading the stock to overweight from neutral, raising the price target to $97 from $35 a share. Wells Fargo also upgrading shares to overweight, raising their price target as well to $100. So, it certainly feels like when you look at the home furnishings industry, as we call it, where Wayfair competes, things are starting to stabilize. And we're seeing some of those results with that stock up roughly 16% today. Well, shares of Clorox closing the day up about 9% here following an earnings beat. The company reporting net sales of $2 billion, a 12% growth since last year. Clorox also projecting better than expected guidance for fiscal 2024 as they expect to exceed its pandemic years. And that is saying a lot, Diane, when you think about how Clorox performed during the pandemic. But look, this is a company that raised its prices, that has certainly boosted profits. But, I think it's interesting because even though we're talking about that guidance being optimistic, they also kind of had a cautionary note here saying that consumer demand is robust, but they're seeing economic activity becoming a little more challenging in the months ahead. The CFO saying specifically, we expect it's going to continue being a challenging economic environment, and we continue to expect ongoing cost inflation. So they are still seeing that reflected in their numbers.
They are. However, I mean, it did well. I mean, people are buying the cleaning products and the trash bags. I mean, they make Glad trash bags. So they've had strength there. The filters as well, water filters, cat litter. I mean, this was it. I mean, look, I'm doing a deep dive into their report. Wipes. I mean, I need more wipes. So, Clorox certainly doing well. Wall Street rewarding it with a big thumbs up today. All right, switching gears. Former President Trump arriving in Washington, D.C., and now likely in a courtroom to be arraigned on 4 criminal charges related to his alleged efforts to overturn the 2020 election. This is fresh news now. Yahoo Finance's Alexis Keenan has the details. Alexis, take us through what is going to happen inside that courtroom today.
Hi, Diane. Yes, this arraignment, it's happening in federal district court in Washington, D.C. You can expect that it will take approximately 15 minutes if things go as they are typically planned. Trump will be advised by a magistrate judge that he has these 4 new charges that he's facing in connection with his alleged role to reverse the 2020 presidential election. Now, these 4 new criminal charges, 3 are conspiracy allegations, along with 6 unidentified co-conspirators. They are conspiracy to defraud the United States, conspiracy to obstruct an official proceeding, conspiracy against rights, namely those are the right to vote and the right to have your vote counted when you vote in a presidential or other election. And finally, there's an obstruction charge for attempting to obstruct an official proceeding. Now, the judge will ask former President Trump, if he is represented by counsel. He will be asked to enter a plea, most likely. And the judge will also set some discovery and motion scheduling for this case to go forward. Now, we may or may not get a trial date today. That's up to the judge, but we can expect when the trial date is set that it will be set for somewhere between 10 to 12 months from today. The judge must offer the former president bail, but we can expect that he will get the same bail conditions as he did in his prior criminal indictments, and that would be to be released on his own recognizance. I understand that he will not be having to sit for a mugshot today, but he will be fingerprinted. And a lot of questions, I think, will be swirling about whether these co-conspirators are people who the government knows who they are. They say known and unknown. And will they be people who the government is working on or expecting to testify against the former president in this case?
And Alexis, let's talk about just all the legal battles that are happening. This isn't the only one. This is his 3rd indictment this year. Give us just more context about where this all stands and what this all means right now.
Sure. So this is, like you said, it's the 3rd indictment in just a small span of 4 months. And to those prior cases, those 2 other cases, the former president pled not guilty. One is a federal case where prosecutors are alleging that the president kept classified documents after having left office. The other is a New York State case brought by prosecutors. They're alleging that the president falsified documents in hush money payments to that adult film star, Stormy Daniels. Now, I just want you to briefly take a look there at the screen. Take a look at the trial dates and where they would fall if things stand where they are set as of current in relation to the presidential election. You have that federal case over the classified documents set for May 20th of next year. And then you have the New York case before that, supposed to happen on March 25th of next year. Earliest primaries going into the presidential election start on March 5th. The latest go through mid-September. So you have these cases falling right kind of in the thick of this. And then you have this newest federal case in D.C., the latest probably happening sometime around July. So all of this could be expected, I think, to cause quite a lot of disruption, or maybe President Trump will use it to his advantage and have a lot of publicity around it as well. A lot of the legal experts I've been talking to say that he will probably find some way to take advantage of it based on his past history.
Certainly possible. I mean, we've certainly seen these instances of this be polarizing and kind of driving support or division in general, whether it's the support side or the those against, but certainly difficult to continue to watch this unfold. Alexis Keenan, thank you.
Well, Amazon earnings just hitting the wire, with earnings coming in at 65 cents, beating the 35 cent a share estimate. Revenue, a beat, coming in at $134.38 billion. The estimate at $131.63 billion. Sales guidance also beating expectations, with 3rd quarter range $138 billion to $143 billion. And we are seeing Shares of Amazon pop on the back of that, up nearly 7%. Diane, when you think about what we've been watching with Amazon, AWS, a big one, especially on the back of what we heard from Microsoft as well as Alphabet about decelerating growth, companies sort of pulling back on spending. We did see AWS net sales, excluding FS there, coming in at 14% growth as opposed to a little weaker. Well, that's subscription services. Sorry, AWS net sales coming in about 12% versus the 33% year-on-year estimate that was there. It's interesting to see also online store net sales there beating in $52.97 billion. So we're talking about 4% growth year-on-year. Versus the $52.45 billion that was coming in. A number of numbers to get through here, but really at the end of the day, the question going into the call is going to be, where does their AWS growth stand in terms of where things are moving at a time when we have seen a pullback? And then, of course, how are customers responding, especially on the e-commerce side of things, when we have seen discretionary spending go down, customers turn a little more cautious. What does that look like for Amazon?
Yeah, indeed. But the proof is in the pudding here. They've beat, and I know we have this conversation about, is the bar lower, and is it that it's easy to kind of jump over this bar? But there is strength in their beat that we're seeing. I mean, especially when you look at what both net sales. I mean, as you mentioned, the expectations were just over 131 billion coming into this, coming in at 134 billion. Net income, 65 cents per diluted share. I mean, that was also better than expected. It just shows also just the strength of the consumer. The consumer has been one thing we've consistently talked about. Is the consumer weakening? Is the consumer weakening? And now we have these larger macro conversations about it doesn't look like it now. So there just shows by their numbers that there is strength there, and that AWS picture also showing stronger than we expected to see. Another thing that you and I and others talked about, and it doesn't show up in the numbers in this quarter, but this would be kind of in the third quarter, the Prime Day sale. They said that was its biggest day event. So we'll still be looking forward what they speak to in terms of guidance when they have their earnings call today.
Yes, certainly. And again, that stock up roughly 6% right now. Let's turn to another name that's reporting here. That stock moving in the opposite direction, and that's Airbnb, trading lower, down more than 4% right now after reporting its Q2 earnings. It's a beat on the top and bottom line for the company. Let's run through those numbers there. Revenue coming in at $2.5 billion versus $2.4 billion that was expected. Adjusted earnings per share coming in at 98 cents. Airbnb seeing strength in gross bookings coming in above the street's estimates at 19 billion. That's 13% higher than last year. But here's the big miss. Nights and experiences booked. They reported 115.1 million, up 11% year on year, but the street was expecting 118 million. Airbnb saying that guests are traveling further. Cross-border nights growing by 16% in Q2 compared to a year ago. Worth going back to this number, though. We're talking about nights and experiences being a miss. Also, average daily rate showing slower growth. It was up just 1% year on year. ADRs, by the way, down 2% in North America as hosts reduced some of their prices. So if you'll recall, Airbnb has been putting in a lot of these features to really, as they've described it, add value onto their platform, whether it's rooms or pricing transparency. And they have said they're seeing those consumers really choose value. Now, on the one hand, that's good because they're booking on Airbnb, but that's also bringing the average daily rate down a little. Now, outlook in terms of guidance for the quarter, we are seeing them, the company saying they expect to deliver revenue of $3.3 billion to $3.4 billion. But interesting insight here, especially in the travel space. Airbnb has been a really strong name, but they have seen a bit of a pullback, at least on average daily rate.
Yeah, and that was one of the things I literally underlined that when I was looking through their report about the average daily rate, and then the nights and experiences booked, I mean, coming in weaker than expected. And it goes to that point about, is there weakness coming in the travel? I mean, look, we just talked about Expedia earlier, and then some of the softness that we saw there. So despite them beating in terms of revenue or profit, it's that kind of future path. What does their growth trajectory look like? Can they hold this up through the next quarter? And there appears to be some slowing there.
Yeah, and, it's important to know that Airbnb is obviously a global company. They are in so many markets internationally, and when you look at their numbers, it still points to kind of the opening that we're seeing. The company's talked about the huge growth they're seeing in Asia, one of the very last regions to lift a lot of these pandemic restrictions. So that upside is still coming through. But as we've heard with so many companies, travelers feeling a little more cautious as well. One more thing to note, Diane, because I was curious. I think a lot of people are curious. Airbnb's Malibu Dream House.
Yes.
I don't know if we have a photo of that, but that now is the company's most popular listing ever. Yes. 250 million social media impressions. And you have to wonder how many people went to Airbnb platform, looked for this, and then said, well, you know what? I'm here. I'm going to book another travel destination.
No, I
How
love
much of that percolated through?
I know, and they're flipping it over to Ken next. I guess it's going to be on loan to Ken and get some. They said Kenergy, I guess is what yes.
I say we pull in all our money and spend one night there.
Let's go. Done. All right, coming up, we're diving deeper into the numbers coming out from Amazon as the stock reacts. It's up after hours. Stay with us.
Amazon out with its second quarter earnings, shares rising after beating on the top and bottom line. The company also topped estimates for operating income and delivering optimistic guidance. Joining us now is Rohit Kulkarni, Roth MKM Managing Director. Rohit, we are seeing shares rising in after hours on the back of these results. So what's the big takeaway for you?
Clean beat and raise numbers. Fundamentals are better than expected. Amazon coming above their high end of the guidance, and 3Q outlook being kind of the low end of 3Q outlook is above the street. So this is as emphatic a beat and as emphatic a raise that we have seen in from Amazon in probably 18 months. So, and the big other takeaway is AWS. The cloud growth has stabilized. That's what they have said in the letter. And that means we are seeing an inflection in cloud growth from Q2 to Q3. I believe the moment people start to digest an inflection, that's when the stock goes even higher.
Rohit, I want to ask you, when it comes to when you get on the earnings call, what are you looking to hear with regard to the path and trajectory for AWS growth?
I think what we would love to hear is two things. One is how is AI contribution towards AWS kind of trending? Microsoft gave somewhat of a glass half empty kind of situation there where AI contribution started to decline for them. If Amazon provides extra color about how AI and AWS are going hand in hand, I think that should help the stock and the sentiment. And second, I think they're already talking in the letter that AWS has stabilized. So how high can AWS growth go in the near term, given the year-on-year comps are easier in August and September? I think any extra color around that, I think those two data points on AWS would definitely help with the sentiment. The third point is Prime Day. Prime Day was the biggest Prime Day they have had in the history. Obviously, we see that in the numbers. We see that in the 3Q guide. But just generally how they see the state of the consumer, state of buying patterns of consumers, trend in the rest of Q3 is kind of assumptions around that would also help.
Rohit, there were a lot of concerns about the AWS growth going into these results, particularly on the back of what we heard from Microsoft as well as Alphabet. A lot of companies pulling back some of those investments. You know, I've heard you say many times now that growth, at least in the cloud, has stabilized, but it certainly feels like the outlook is a little more positive for Amazon in this space. What is AWS getting right?
In my opinion, AWS has been working on a complete full stack AI offering, which is they have their AWS AI chips, which is for your large language model training and inferencing. They have their own chips that they have probably, I would say, anywhere between 3 to 5 year lead versus Microsoft and Google. They have been working on that over the last 5 years. And on top of that, I think AWS probably has the best data offering across all cloud vendors. So think about the first thing that anyone wants to do with the AI in the cloud. You want to get all your data into the cloud. There is a gravity of data, and that data gravity helps AWS because they have probably the best database offerings, the best data warehouse offerings across all cloud vendors.
And Rohit, shares of Amazon are up more than 50% year to date. How high are you expecting this stock to go this year?
Again, Amazon is our number one mega cap pick, is what we have published for second half and probably heading into 24. In my opinion, I think we are at couple of inflection points at Amazon. The first inflection point is obviously AWS, which we see. The second one, which we are yet to see, is our margins in North America and international retail. I think that's still work in progress, but after having cleaned up their act around fulfillment, around logistics, around hiring, 6 quarters in a row, their employee headcount has declined. That not a single company has done that in the last 6 quarters in a row. So as we start to see, as we get to Q4, we should start to see retail margins ramp up, and that brings the stock higher even more from where we are right now. Obviously, our price target here is 155, but we see that grind higher given where the numbers will shake out after tonight.
Rohit, we have seen a big push from the company to increase third-party sellers, and we're seeing third-party seller services net sales coming through from there at $32.3 billion, about an 18% growth year on year. How much higher how big of a driver do you expect that to be when you think about the ad dollars coming in from there?
I think it's a fantastic virtuous cycle that Amazon has figured out between their fulfillment by Amazon, the Prime offering, and their third-party seller offering, as well as advertising. So once sellers are onboarded, you are on the fulfillment by Amazon offering, and then you are also in the advertising thing. So I feel they are taking away share from larger advertising companies, say like, for example, Google and Facebook, and plus they are taking away share from smaller e-commerce providers. So in my opinion, this is still something that, based on their kind of 3 pillars of e-commerce, which is advertising on Amazon, fulfillment by Amazon, and obviously the Prime, that creates a moat that probably we are not going to see that break anytime in the near future. Plus, again, they have a new CEO on Amazon.com, Doug Harrington. I think what he's been saying is that decentralized fulfillment centers has created the best and the fastest fulfillment network that has ever existed on planet Earth. So what that means is, the moment you start to get that speed of delivery, the speed of convenience, I think yeah, it's hard for we are on the cusp of the next big unlocking of shareholder value for Amazon, and I think we have just started.
Rohit Kulkarni, Roth MKM Managing Director. Appreciate you hopping on today. Good to talk to you.
All right, let's do a check of the markets after the close. This is sponsored by Tasty Trade. All three of the major indexes fell for the day as the downdraft continued on Wall Street. Down, not by much, though. Investors cooling their heels again. The Dow finishing down 66, S&P 500 down 11, Nasdaq off 13. Investors just cooling their heels ahead of the jobs report tomorrow. Meantime, Hasbro's stock on the move today. That stock up 1% after the toy giant announced its E1 film and TV business will be sold to Lionsgate in a $500 million deal. Hasbro CEO Chris Cox joined Yahoo Finance this morning to discuss the deal, as well as its latest quarterly results. Take a listen.
We've been in a process with E1 for about 9 months now. We announced it back in November. It was just the right thing to do for the company. You know, Hasbro has become great because of play, and we're really refocusing on toys and games. We'll continue to have a great entertainment presence, but when we looked at E1 and we looked at the film and TV division in particular, there was just a lot of brands that we weren't going to make action figures or board games for, and we figured there was a better home for it.
Does this deal, Chris, help you save money?
Yeah, you know, from a high level perspective, we spend about $600 to $700 million a year in film and TV production, of which, you know, from an operating cash flow perspective, we fund about 50 to 100 million of that from Hasbro corporate. So there will be that upside for us. And then the margins inside of the film and TV division, while it's profitable, it's nominal. So it'll be immediately margin accretive to us as well. And then last but not least, you know, based on the proceeds of the sale, we're going to be able to pay down a minimum of $400 million of debt and accelerate our path to our long-term debt to EBITDA ratio of 2 to 2.5.
Got it. I want to make sure the investor base understands this. Is Hasbro out of the content game? Are you still playing, you know, you still have an eye toward bringing some of your biggest franchises to life on a big screen or a streaming platform?
Oh, for sure. Yeah, I mean, the film and TV division is probably about 85% of our entertainment revenue from last year. We still have huge brands like Peppa Pig, a lot of animation efforts, and we have over 30 projects in development across live action and animation, including future movies for Transformers, G.I. Joe, TV shows for D&D, Magic the Gathering, as well as a host of projects for our board games, including a movie that we're developing based on Monopoly with Lionsgate. I think the big pivot for us is we're going to be returning to much more of an asset-light model where we work with the best and brightest in Hollywood and leverage their distribution platforms and their content creation know-how. And we'll focus on what we do really well, which is play.
Yesterday, Chris, I had a chance to catch up with Intel CEO Pat Gelsinger, and his company is also going through a transformation. But he said something to me pretty powerful, I think. You know, that green shoots in his business that started 3 months ago are now morphing into plans. I think he meant the turnaround is starting to take shape. Where does your turnaround stand?
Oh, I think it's palpably taking shape. You know, we entered the year predicting our first half would be down 20%. After Q1, we said it would be down 16, and after Q2, we're down 12%. Our POS has been picking up through the year. You know, we're still not fully to green, but we're definitely seeing improvements in our toys segment. And our Wizards of the Coast segment continues to be what, in my opinion, one of the best stories in all of games. You know, we see that segment up minimally high single digits this year. And that's on a track record of, I think we have a 5-year CAGR of around 13%. So there's a lot to focus on in terms of our turnaround story and in terms of our momentum around it.
What's next in your turnaround story?
Well, I think for us, it's really for a couple things. On entertainment, we're going towards an asset light model. I think that's going to save us money. It's going to raise our margins, which is important for us. I think in toys, it continues to be driving the innovation funnel there, working with our retailers to be the best execution game in town. And then in games, you know, we're a toy and game company, but I really place the emphasis in games. That's an incredibly high margin business for us, a great growth business for us. And I think you're going to see us lean in more and more there. we've got a $2.1 billion games portfolio with a better than 30% operating profit margin. Over the next 5 to 6 years, I'd like to see us make some material progress in continuing to grow that and keep that bottom line super healthy.
Chris, a lot of your biggest customers, Walmart, Target, you name it, are thinking about what games, what toys they will put on the shelves this holiday season. What are you hearing for them right now? Because as we all know, before we know it, we'll be out shopping for gifts again.
Yeah, well, you're seeing a couple of our favorites right here and some of our retail partners' favorites. This little guy, Furby, we sold out on initial allocations in the first 72 hours. So we think that's going to be a toy of the holidays. We've got some great new Monopoly collaborations. This one's based on Super Mario Brothers, but we did one with NBA Prism, which basically vaporized in the first half of the year. And probably one of the games I'm most looking forward to in the back half of the year is our first collaboration with Mattel on Barbie Monopoly. So taking one of the biggest names in games with one of the biggest names in dolls and really having a nice giftable moment. And then, across the portfolio, whether it's action figures with our hit movie for Transformers Rise of the Beasts, or just other new games that we're doing like Twister Air, I think there's a lot of reasons for optimism in the back half for us.
Chris, you mentioned the Barbie movie, and really it's sucked the air out of a lot of different things. Clothing at Gap, at fast fashion retailers. Do you think it has sucked the air out of just toys unrelated to the Barbie movie? And does that hurt a Hasbro this holiday season?
No, I mean, what we're seeing is the toy category is starting to pick up a little bit. Our POS has been positive, especially when you X out kind of exited licenses for the past 4 or 5 weeks. Transformers Rise of the Beasts, we've had an 83% pickup in point of sale since the release of that movie. Spider-Man, since Across the Spider-Verse, we've had a greater than 100% pickup in point of sales. And then again, we're selling new items like Furby, which retails for around $60, and that's selling out instantaneously. So, I give my congratulations to Mattel. I think they really did a fantastic job with that movie, and particularly the marketing campaign around it. And I think if anything, that movie isn't sucking the oxygen out of the category. It's proving how vital the category is and how important the IP is.
All right, a big thanks to Hasbro CEO Chris Cox, as well as Yahoo Finance's Brian Sozzi. Coming up, Apple earnings coming hot off the press. We will break down the numbers on the other side. Stick around.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
We are watching shares of Apple trading. It's just a little lower, down about 0.5% here on the back of their earnings results. The company posting a third straight quarter of declines in terms of revenues. Earnings coming in at $1.26. Estimate was $1.21 a share. Revenue beating expectations, coming in at $81.8 billion. Versus the estimate of $81.56 billion. Let's try to break down some of the categories for the company. iPhone, certainly a big one that investors are watching. That revenue was a miss, coming in at $39.67 billion. The expectation was $39.79. Services beating here, their revenue at $21.21 billion versus the $20.7 billion that was expected. We are also seeing iPad revenue a miss. And then the wearable space, That was a beat there at $8.28 billion versus $8.38 billion that was expected. One of the markets we like to watch very closely, Greater China, that revenue coming in much stronger than expected at $15.7 billion there. Joining us now is Bob O'Donnell, Tech Analysis Research President and Chief Analyst, and Ray Wang, Constellation Research Principal Analyst Founder. Good to have both of you on. Bob, let's start with you because, you look at iPhone revenue being there and miss, but this is something that every smartphone company out there has had to struggle with in terms of declining demand. What do you make of the numbers coming out from Apple?
You know what? Actually, they're not bad. I mean, all things considered, there was a big expectation that the numbers would drop a fair bit this quarter because, as you pointed out, there's a huge drop in smartphone shipments across the Android ecosystem. Qualcomm had a bit of they did reasonably well. They made guidance, but it was still lower. And they power a lot of the Android ecosystem. Of course, they still supply modems to Apple as well. But, I think all things considered, as you pointed out there at the end of Kiko, the China numbers are better than people expected. And of course, once again, it's services that kicks in and really makes up the difference for Apple. And that's what I think a lot of people were hoping for. As long as those iPhone numbers were close, and clearly they were off, but not terribly, you knew the services could kick in and fill in the rest.
Ray, let me pick up on that point that Bob just made there in terms of, this not being as bad. Obviously, a lot riding on what's about to come for Apple with that September event and the iPhone 15. How do you look at the numbers today in the context of what is traditionally a weaker quarter for the company?
Bob's absolutely right. This is much better than expected. But the most important thing really is the active number of users, active devices that they have. This is all about how much money they can make per device. It's not about total iPhone sales. And what they were able to show is that services are continuing to grow and the non-iPhone sales around wearables is also picking up. Those two are complementary. And when you think about what the average spend per user is, that number has continually gone up over the last 24 quarters. And that's really because of their ability to actually expand iPhone and expand services growth. Those two things have actually made up to be the better part of the story. And by the time we get to a September event, right, those sales will then hit into the next cycle and to the next year. So that's actually a good news for a lot of investors. But more importantly, it's good to see that on the high end, we're still seeing growth. China has recovered. And of course, we've yet to see what happens with the India numbers. I'm not sure the breakouts were in there. So.
Yeah, I didn't see the breakout so far in there. Ray, I want to pose this question to you because, for instance, on their last earnings call, Tim talked about that a lot, about the opportunity in India. What are you looking to hear on the call when it comes to the India market?
Yeah, I'm hoping someone asks the question about, hey, have they seen gains in India now that they put 3 flagship retail store operations in there? There's plans to do manufacturing in India, and I think that's going to be a long-term winner for Apple over the next 3 to 4 quarters. That's something people are going to watch for those volumes. And then, of course, thinking about what else is coming out of India in terms of the services growth, that will be the attach rate to what's actually happening with the devices.
Bob, let's pick up on that point about India, because I feel like we've been talking about the potential of India for many, many years now.
Yes.
It does certainly feel like Apple has been planting their roots. They're starting to see some of that take shape. But how do you think investors should be looking at that market where it is right now in the context of China and some of the headwinds that a lot of companies like Apple are facing there?
Well, I mean, look, it is going to be incredibly important. I think there's going to be a couple of unique challenges to India. First of all, of course, we haven't seen as many premium phones in general sell there. It's much been more on the lower end. Now, Apple does have a bunch of lower cost, older versions of iPhone products. And to Ray's point, it's once you get an iPhone, then you get attached to services. Now, the other concern, though, with India is I think we're going to see some slower attached to services there because it's very much more of a hardware-focused market. Obviously, they use services, but I don't think to the degree that we've seen in some of the other markets. So I think India is going to be interesting. I think it will be different than China. I don't think we can think of it the same way. I think you'll see a little bit lower ASP in terms of the phones that are being purchased there. I think you'll see a little bit of lower attach, but it's still a huge opportunity. And they have almost no installed base in India. It's extraordinarily small. So the great thing is it's almost nothing but upside for them there.
And Bob, I want to ask you in terms of both the iPhone 15 and say the newest Apple Watch, is that enough to be supportive of Apple's continued strength?
Well, yeah. I mean, look, it's going to be, we're going to see upgrades. It's not going to be probably radical, more than likely, right? Until Apple does, say, a foldable along the lines of a Samsung or what have you, which I think eventually they'll do, maybe a foldable iPad first, but eventually I think we'll get there. You know, it tends to be incremental upgrades. I think you'll see that again this year, but it's enough. Remember now, we're not in that phase anymore of everybody upgrading every year. It's every couple of years. So most people are going to be upgrading from, say, an iPhone 12 or maybe a 13 or even maybe an 11, right? And so when you make the comparisons between the 11 or 12 versus the 15, they are big. And so that's the important thing to bear in mind in a very mature smartphone market, especially here in the US and a lot of parts of the world where people, you know, are big iPhone fans. That's how they think about it. So with that in mind, I think they'll do just fine. They'll have enough things there to keep it interesting, and that will continue to drive the market forward.
Yeah, Ray, you know, we got those reports a few weeks ago about Apple potentially sort of keeping the shipments with the iPhone 15 pretty steady to where it was a year ago. 85 million units is what Bloomberg reported. Does Apple have to raise the price on especially the Pro level to keep this revenue in this cycle going when you consider, to Bob's point, sort of the broader length of an upgrade cycle? What are we talking about now, 4 years?
Bob's right. We've stretched out the replacement cycle, but we're in a super wave of replacements, right? There's something about 200 million units that could potentially replace. 85 million is a good number for what's going to happen on the high end, but of course there's stuff in between. And yes, most people are switching out phones every 2 to 3 years. The services plans are 2 to 3 years when you look at the big carriers in North America, and the same thing that's happening in other markets. So I think that's important. But along the way, right, we're seeing gross margin also go up, right? It's 0.3% versus what was estimated, but I think it's a very important piece. And so you're going to see not only just the additions of an iPhone 15, which actually helps with the launch, you're going to see additions in terms of updates to the Mac family and the iPad family. You saw there was a 20% year-over-year decrease on the iPad. There's going to be new products along the way that will fill in the gap. And, you know, the surprise is the wearables. No one expected the wearables to continue to do this well. You know, remember when Apple said they were going to announce a watch, everybody was like, you know, is that going to make a big difference? And it has. And you can see that as they've diversified, even though the iPhone is still about 50% of their revenue.
And Ray, I want to ask you, so services revenue was a beat, right? What does Apple need to be doing more to incorporate? What are you looking to hear when it comes to generative AI, considering they were a little late to the party in that respect?
Well, here's the interesting thing. On one hand, they're a little bit late to the party for marketing AI, but on the other hand, they've been incorporating AI in all their devices for quite some time. They've got AI in chips, which they've been talking about for years. They are able to suggest things, right? Siri's been around for quite some time. So they're not ahead on AI. They're not behind on AI, as people are saying. They're actually ahead on AI because they don't talk about AI saying, hey, here's the shiny object on AI. They say, here's the benefit of what AI can do for you. And I think that's the difference and the nuance you should be listening to, or we should be listening to on the earnings call, to be able to understand how far along the AI spectrum they are and where is it benefiting users and where it's benefiting them in terms of their network.
Yeah, Ray, I feel like you just tapped into your inner Tim Cook in the framing of that AI discussion. But Bob, the last time we talked about this, you highlighted this when the company unveiled its headsets, the Vision Pro. You said this is great, there could be mass adoption, but where is the AI play in all of this? How do we look at that? The Vision Pro, where the future is, obviously it's not a big revenue driver immediately, but if they don't have that key AI component, what does that look like?
Well, a couple of things. So on Vision Pro, look, they've already pulled back. Even initial estimates, some people were saying 1 million. Now it's down to 400,000. I mean, it's going to take a long time for that category. I think it still has a long way to go to really be the AR sort of product that people want. But I'll say a couple of things. So Apple as Ray said, Apple has been using AI, but they've been using sort of more traditional AI, machine learning, things like that. What they have been missing is the new generational AI, generative AI stuff. And that's missing. And yes, Siri's been there, but look, we all made jokes about Siri because it never really worked well. Mind you, nor did Alexa, nor did Google Assistant. And you're seeing both those companies, Google and Amazon, saying, we're going to put a foundation model underneath these assistants, and they're finally going to be able to do what we want them to do. I think you'll see the same thing happen with Siri. But Apple, again, is going to take the Apple approach. They're going to frame it just very nicely. Like you said, I think Ray did a good job of providing the perspective that Tim will probably say. But when they're ready, they will launch with full force about, generational AI-based stuff. And I think you'll see it in Siri. You'll see it in other places. Right now, they'll probably talk about filtering on the camera and other things that we've seen other companies talk about. But eventually, you're going to see some of those services. And I think Apple will find clever ways to integrate it. They're always going to be there. They're going to wait till they feel like they've got a unique angle to it, and then they'll pounce. And I think we'll see that sometime in 24.
Bob O'Donnell, Ray Wang, great to get both of your perspectives on the back of these numbers. Appreciate the time.
Thanks.
Thanks a lot.
All right, we want to bring in another earnings picture. It also starts with an A. That would be Amgen, though. We're switching to healthcare now. Its earnings, Al's quarterly report card, beating estimates on revenue and earnings per share. Yahoo Finance's Anjali Kemlani has been speaking with the company's top C-suite, and she has the details.
That's right. Amgen with a strong quarter again. Some interesting things to pull out, but just let's look at the top line numbers first. Of course, like you said, beating estimates, especially on revenue and adjusted earnings per share, coming in a little bit over at 8% up on that earnings per share, like you can see on your screen, as well as on the revenue side, beating out close to $7 billion. So that's where things are right now for the top line. Now, two major drugs that are in focus here for the company. One is Amgen, that's the Humira or AbbVie's Humira biosimilar. They did report an increase in sales of about 29%, but still a little bit slower than expected. So they missed on that one. And then Lumakras, another drug that they have, did say that sales were flat essentially for that one, but they are expecting sort of more to come down the pike with more indications, currently working on other uses for the drug. So that's sort of where things look for them. Meanwhile, I did also ask CFO Peter Griffith about one of the topics that I think has been really interesting for pharma this season, especially, and that's China, just the strength of the Asia Pacific market. And he did say that it came in for about 46% of revenue. They did note that ex-US sales were quite strong this quarter. So that's an interesting sort of story that I've been seeing throughout the season. Meanwhile, I also discussed the impact of the Inflation Reduction Act and Medicare drug pricing, which is really on the horizon for a lot of companies. And he had a really interesting comment about that. Peter Griffith told me, quote, "Well, we're well positioned to manage through a declining price environment. We're evaluating our portfolio given the impact of this legislation, and we'll make appropriate resource allocation decisions, but nothing abrupt." So that's really interesting because it kind of falls in line with this, talking point that the industry has had, that it is going to impact innovation and how companies, even ones and especially ones as large as Amgen, will be operating. So should be interesting to see how that impacts in the second half of the year.
Interesting indeed. Anjali Kamlani, thank you so much. Coming up, it is closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned. Well, if you're on social media, who isn't? You may have noticed an uptick in the number of photos friends and family are posting from Italy, Greece, and Spain. Travelers seem to be showing a preference for international travel, and airlines are taking note. Domestic airfares currently down 11% from last year, whereas international airfares are up 10%. That's according to Hopper. For more on this, we turn to Haley Berg, Hopper lead economist. So, Haley, take us through what's behind this divergence in price.
On the international front, we're actually seeing record high fares, and this is being driven by the incredible amount of demand we're seeing to the region, as well as low supply. Airlines haven't brought back 100% of their 2019 capacity on these routes, and jet fuel prices still significantly higher than they were in 2019. So on the international front, still a lot of headwinds to overcome with fares, but on the domestic front, demand has normalized. Short-haul flights are less impacted by high jet fuel prices. And we're seeing a lot of competition. Airlines have brought back more capacity than they had in 2019. So diverging trends for different reasons on each of those, but we're still seeing very strong demand for both domestic and international.
Yeah, you talk about the new supply, or at least the new routes that have come online, at least domestically, sort of going back to where we were back in 2019. Airlines have also slashed prices to try and get consumers to stay a little closer to home. How successful do you think that's going to be? I mean, what's driving the travel decision?
Right now, what we're seeing is the end of summer. Most Americans are prioritizing what we call bucket list vacations. They're willing to spend $1,000, $2,000 on that all-in trip to Europe, to South America, to Asia. But that's going to shift very quickly. The shoulder season, which is typically September and October, is actually the cheapest time of year to buy a flight, to take a trip. And travelers will start shifting back towards domestic. By the time we get to Thanksgiving and Christmas, the majority of travelers will be looking at domestic because most go home for the holidays. So though we're seeing international really having a moment right now with incredible demand, we are expecting to see a shift back towards domestic, which will probably put some upward pressure on prices.
Now, Haley, I want to know if you've seen, in terms of, especially when you think about domestic travel, or travel in general, any demand destruction due to just kind of all the problems that we've had with regard to just snafus at the airport, flights being canceled. Has that done anything to demand from your view?
It's pretty incredible that it has not. We've seen record high delays, cancellation rates, especially from some pocket airports that have been adversely impacted by everything from weather to technical meltdowns. Despite that, we're still seeing incredible demand, especially for those international trips, but also for domestic. We're not seeing it slow travelers down. What we are seeing is a preference by travelers to spend a little extra to protect those trips from disruption, from unexpected delays. On the Hopper app, we see about 10 to 20% of customers adding a disruption protection product. So they still want to take the trip. They're still spending that budget on travel, but they're saving a little bit of that budget for protection products to help give them peace of mind, because these disruptions are abnormal and they are top of mind.
Haley, what does that demand look like for travel going into year end? Are we starting to see more bookings for the holiday travel season and beyond?
We aren't seeing a surge in holiday travel bookings yet, which is a good thing. Something that we see coming out of the pandemic is user behavior, traveler behavior about when they book is very different. And a lot of travelers are booking way too far in advance or way too close. So the sweet spot for holiday bookings is really going to be mid-September to mid-October. That's when prices will be the lowest, and that's when we hope to see the majority of bookings for the holiday, although we always see a surge in those last-minute Thanksgiving and Christmas bookers.
And Haley, I got to ask you one fun question, because you mentioned bucket list. I know what's on my bucket list. That would be Bali, but not this year. What's on your bucket list?
Definitely Greece. I've seen way too many photos from the beaches in Greece, and I'd definitely like to go there myself.
Great choice. That actually should be on my bucket list. I'm adding that to my bucket list as well. Well, we'll go together. Haley Berg, thank you so much.
Great being with you.
All right. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. President Trump pleading not guilty to federal charges tied to his alleged efforts to overturn the results of the 2020 election. He faces 4 felony charges of conspiracy and obstruction. The former president's appearance today marks his 3rd arraignment in the last 4 months. Meantime, Amazon shares soaring on second quarter results. The tech giant posting results after the closing bell, beating estimates on the top and bottom line. Amazon's third quarter revenue guidance also coming in above expectations. One analyst telling us that the report shows Amazon's cloud business has stabilized and it's hitting an inflection point, and that's what's going to drive the stock higher from these levels. Plus, Apple also reporting earnings after the close. The company beating estimates on the top and bottom lines, but iPhone sales did miss expectations, and overall revenue fell for the 3rd quarter in a row. That news weighing on the stock.
It is time now for What to Watch on Friday. The U.S. Labor Department delivers the latest jobs report. The U.S. economy is expected to add 200,000 jobs in July. That's slightly lower than the 209,000 added in June. The report will also provide insight on 2 key factors for the Fed: unemployment and wage growth. The Fed, though, has made it clear it will look at the totality of incoming data before making its next policy decision. Turning to earnings, Nikola is gearing up to report its quarterly results. Heading into earnings, investors enjoyed a week of positive news, with the company surpassing 200 orders for its hydrogen fuel cell EV trucks. But investors are going to be watching closely at the company's cash on hand and costs in the second quarter. Other earnings on deck for Friday include Fisker, Fubo, and XPO. Well, that'll do it for today's Yahoo Finance Live. Be sure to come back here tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Have a great evening.